Welcome to this session 4 of Unit 2 of ACC 201D. Session 4, we are looking at a subsequent measurement of financial asset. Subsequent measurement of financial asset. In our previous sessions, we looked at what financial instruments are. We define financial instruments. We look at the initial measurement of financial instrument and the subsequent measurement of equity instrument with the issuer perspective. So in this section, we'll continue with accounting for financial instrument and the focus being subsequent measurement of financial asset. We've agreed that the initial measurement of a financial asset is at fair value. Now, if you are measuring it, or we are not measuring it through profit or loss, then we add transaction cost to it. What are our objective for this session? At the end of this session, it is expected that we'll be able to outline the measurement option of financial asset and when each option can be applied. We also have to look at how to apply the measurement rules to account for financial instruments. So these are the two main objectives we have to look or achieve at the end of this session. Subsequent measurement of financial asset. IFRS 9 divides all financial assets into two classifications: the amortized cost and fair value. Fair value, however, has two criteria, and it is either you measure at fair value through profit or loss, or fair value through other comprehensive income. And we've looked at what fair value is. That is IFRS 13 in Unit 1. And it is that same idea or that same fair value we are talking about here. Now, for an instrument or financial asset to be measured at amortized cost, these two conditions must be met. We have the business model and then the contractual cash flow characteristics. Now, the business model is that we have to look at the objective of the holder. Is it to hold the financial asset in order to collect contractual cash flows? Is it holding the financial asset till maturity? This is what from the business model. You are holding it to collect contractual cash flows, and you are holding it till maturity. Now, the contractual cash flow characteristics. What are the characteristics of the contractual cash flows that form the business model? And with this, we are saying that the terms of the financial asset give rise on a specified date to cash flows that are solely payments of principal and interest on the principal amount outstanding. So here, you said we are going to collect a contractual cash flow. So there are specific dates attached to these contractual cash flows, and the payments that are going to be made is based on the amount or the principal and the interest outstanding, and the payment is solely going to be based on that. So there is a date, a specific date attached to them. For example, you have to be paying the interest annually at the end of each year. So that becomes a date, and the principal to have a specific date that it must be paid or received. So these are what give rise to the business model and the contractual cash flow characteristic. These two must be met before you can measure the instrument at amortized cost. Now, when doing this, during the amortization, you have to measure the instrument using the effective interest rate, or use the effective interest rate to do the amortization. Here you have the coupon rate and then the effective interest rate, the rate prevailing in the market. So you have to make use of this in doing the amortization. Let's take an example and see how we will go tackle a question using the amortized cost. They say Agate Limited purchased 10% debentures of face value of 100,000 Ghana cedis issued by Adum Limited for 99,500 cedis on 1st January 2016. The debentures will pay an annual coupon every December 31st and be repaid after 5 years at 100,100 cedis. Agate Limited incurred transaction cost of 200 cedis and the effective rate of interest is 10.10%. The entity intends to hold this investment to collect the contractual cash flows required. Show how the transaction will be presented in the books of Agate Limited. So when you analyze this question very well, Agate Limited here is the one purchasing. So he become the holder, the acquirer, and to Agate, it is a financial asset. This was issued by Adum Limited, and Adum became the issuer. So to Adum, it is either a liability or equity. So you have to pay attention to whose transactions or whose statements you are going to prepare. If you are preparing for Agate Limited, to Agate is the financial asset. But if it is Adum, it's going to be a financial liability. That will inform how you are going to treat it. Whether you are adding transaction costs or you are subtracting. Whether you are charging interest income or interest cost. So you have to know from whose perspective are you preparing the account or the transaction. So here we look at this 10% is the coupon rate, is the interest that will be paid on the debenture. Now the face value, the nominal value of the debenture is 100,000. So if you go to the market now, it is selling at 100,000. However, you bought it, or Adum gave it to you at 99,500. So there is a discount element here. The thing is 100,000, but you are paying 99,500. So it's the 99,500 you have to make use of. So we have the difference of 500 being the discount. So this become the value you have, the 99,500 become the nominal value you have to make use of. The face value is 100,000. After taking the discount of 500, you will get 99,500. Now, the debenture will pay an annual coupon every 31st December. Now, the coupon rate is 10%. The 10% is going to be applied on the face value of 100,000, which has to be paid every 31st December. after 5 years. So the number of years we are dealing here is what? 5. So every year from 31st December 2016, you have to be paying the coupon amount, and the rate is 10%. Who will be paying? Adum. So you, Agate Limited, you would be receiving this as what? An income, interest on the debenture that you bought. And the focus here is Agate Limited. So we are preparing the statements for Agate Limited. So Agate Limited will be receiving 10% of the face value of 100,000, not the nominal value, which is the discounted amount, but rather the face value. Now, if you look at one thing also here, we are giving you, or the face value is 100,000. However, you will be paid after 5 years 100,100 so cedis. So the excess amount of 100 here becomes the premium that you are receiving. So they are paying you in excess of the amount. All right. Then there is also a transaction cost of 200 cedis. Then we have the effective interest rate of 10.10%. Now, what in this question will tell you that you are going to amortize it or you are going to measure it at fair value? So we have to test for the business model and the contractual cash flow characteristics. What is the business model? The Agate Limited is holding this investment of 100,000 till maturity date. It will be received at the end of after 5 years time. So it is to maturity. So this first condition is met. Then we come to the second condition. We want to look at the characteristic of these contractual cash flows that will come in. And there we said that there has to be a specified date of which the inflows will flow to Agate Limited. And what are those dates? Every 31st December, you are going to receive the interest. And then the principal will be paid at the end of the 5th year. So these two conditions are satisfied. With this, you can go ahead and then what? Use the amortization method or the classification by amortization to account for this. Now, with this, we have to make use of the effective interest rate. You have to make use of the effective interest rate in doing the amortization. So we said initially, the transactions have to be measured at fair value. At fair value. We are not measuring this instrument through profit or loss. It's not fair value through profit or loss. So as a result of that, we have to account for the transaction cost here. Now, when you read the question very well, the face value is 100,000, but you are paying 99,500. So there is a discount of 500. So anytime there is discount, you take the discount from the face value. Whatever is left, then you continue to work with that figure. Now, this is a financial asset. So as a result of that, you have to add the transaction cost to the nominal value or to the fair value that we have. So the fair value now is 99,500 plus the transaction cost of 200, giving us the initial measurement of 99,700. This is made up of the 100,000 minus the discount of 500 plus the transaction cost of 500. So this becomes our initial measurement. So the initial measurement is 99,700. Now when it comes to the amortization, these are the various rows when it comes to amortization, or column. You need to get the year column. Then we have the opening balance, or the opening value of the financial instrument for each year. Then we have the income, which we call the effective interest rate, EIR. So the effective interest rate, the rate prevailing in the market. So you have this. Then you have the coupon amount. It is either you receive it or you pay it. In this, you are receiving it because it's an asset for you. So at the end of every year, you have to pay or receive the coupon amount. So Adum Limited have to pay Agate Limited the coupon amount, and this is based on the coupon rate of 10% on the face value. So it's going to be fixed throughout. Then you have the closing balance. Now this is how it works. You take your opening balance, you calculate the effective interest rate on the opening balance. So for example, we have 99,700. What will come under the income or the effective interest rate is for you to apply the rate on this amount. So 99,700 times 10.10% times 10.10%. That will give you a figure, and then you add that. You are going to add this figure to 99,700. So 10.10% on 99,700 is giving us 10070, which is 10,070. Now, then you move on to the cash received, or the coupon that is received. So you are going to receive 10% of the face value. So 10% on 100,000 is 10,000. To get the opening balance, or the closing financial asset, it is the opening financial asset plus the effective interest rate, which is the income you have, the interest you have computed based on the market rate. Then you take out the cash you have received, or the coupon you have received. So you have 99,700 plus 10,070 minus 10,000, giving us 99,770. So this becomes the closing financial asset at the end of the first year. The closing balance at the end of the first year becomes the opening balance for the second year. So this becomes the opening balance for the second year. Then you continue the cycle. You calculate 10.10% on the opening balance for the second year. You get your figure. However, the coupon amount is still the same. So you do opening plus the income or the interest minus the coupon amount, you get your closing balance. The closing balance for the second year becomes the opening balance for the third year. Then the cycle continues. So you get to the last year. Now when you get to the last year, the opening financial asset for the previous year, which is the fourth year, will begin. Then you come to the effective interest rate. Here, you hold on with this figure. You don't calculate the 10.10 straight on this. But this is how you do it. This is the last year. This is the maturity date. So at the end of the 5th year, Adum Limited will pay Agate Limited the principal and the interest. Now we were told in the question that at the end of the 5th year, he is going to pay an amount of 100,100 cedis. So you have 100,100. So this is the amount he's going to pay. Aside these two, he's going to pay the interest for this year, which is the coupon amount of 10,000. So you add the 10,000 to this amount that has to be paid, and when you put the two together, that is how come we are having the 110,100. So this is the total payment you would be receiving at the end of the 5th year, the interest, and then the principal amount that has to be paid together with a premium. Now, you started with this, but you'll be receiving this. So the difference is what you are coming to put here. So get all the inflows that will come to you. So 10, so we have 110,100. Then you subtract the opening financial asset, which is 100,024 from the 110,100. What is left is representing the interest. If you go ahead and compute the 10.10% on this, the figure you will get here might be more. The reason is that at the end of the 5th year, Adum Limited is going to pay you. So you are going to what? Redeem the investment. So the balance here have to be 0. So if you take the opening financial asset plus the income minus the total amount you are receiving, you need to get a balance of 0. And to get this 0, that is how come we are getting the total payment you'll be receiving. Then you take out the opening balance. The difference is the interest that has to come to you. So when you do that, well, you get 0. So the 100,024 plus the 10,076 is giving us 110,100. So if you subtract this plus this minus this, you get 0. So this is how we solve this. This is the effective interest rate. Now, you might be asked to present an extract. We want to look at the figures you are going to make use of in the financial statement. What figures are you going to make use of in the financial statement? Now, when you are preparing the amortization schedule, we are looking for items that has to go to profit or loss account and items that has to go to your statement of financial position. So it's only these two items. So when you come to profit or loss account, these are the items that will go to profit or loss account. Your effective interest rate or the income you are receiving. This is what will go to P or L. And then the closing balances will go to statement of financial position. So to go to statement of financial position, which we call the balance sheet. Then the interest will go to profit or loss account. So it will go to P or L account. So every year you pick the corresponding figure. So this will go to other income or investment income, and this will be the closing balance of the financial asset. Second year, you will send 10,077 to profit or loss account, then 99,846 to financial position as the closing balance for financial asset for year 2. You do that so we get to the final year. The final year for financial asset, you have redeemed it, so there is no other investment there, so the figure will be 0. But that year you will receive the interest. Now, if you want to know the total finance cost or finance income, if it is an asset, it's an income for you. So to Agate Limited is an income. But for Adum Limited, it's going to be a cost, so finance cost. And in that regard, Adum Limited to be a financial liability. This will still remain the same. This will be what? Cash paid. Because when he is making the payments here, it become what? A liability for him or an expense for him. So the total of the effective interest rate is the total finance income. Here, if it is a liability, it becomes the total finance cost. So basically, this is how we go about amortized cost. And this is how we prepare the schedule. Year, opening balance, effective interest rate, which we apply the rate on the opening balance, add it to it, we take out the cash received or the coupon amount, then you get the closing balance. Closing balance become opening balance for the next period in that manner. Okay, so read the manual. Other examples are solved there. The more you solve, the more you get the understanding. Now we want to look at fair value through profit or loss, or fair value through OCI. A financial asset shall be measured at fair value through other comprehensive income if both of the following conditions are met. So we have the financial asset is held within a business model. So the financial asset is held within a business model whose objective is achieved by both collecting contractual cash flows and selling the financial asset. So here, the business model is that you want to collect contractual cash flow. At the same time, you are looking forward for selling the financial asset if opportunity presents itself. Then the second condition is that the contractual terms of the financial asset give rise on specified dates to cash flows that are solely payment of principal and interest on the principal amount outstanding. So when we look at this condition, the only distinction feature between this condition and that of the amortized cost is that with the amortized cost, you are not having the intention of selling the financial asset. But with fair value through OCI, you have the intention of what? Selling the financial asset, at the same time expecting the contractual cash flows. So when you see this indicator and you are also measuring it at fair value, then you have to measure it through OCI. OCI, other comprehensive income. You don't amortize it. As far as it's fair value, if it is fair value, you have to think whether it is through profit or loss or through OCI. And for it to pass through OCI, you test the business model. And in the business model, you are looking for two things: holding it to collect contractual cash flow, and then at the same time available for sale. Then the other one, you look at the characteristic of these contractual cash flows. Are you going to receive the amount at a specified date? And then the amount you are going to receive will be based on the interest and the principal amount outstanding. So this is how we measure fair value through OCI as well. I believe you are getting the understanding. Well, you have to read more and more on it to get it. You won't get it outright, but the more you keep practicing, the more you get. Now we want to look at investment in equity instrument. Investment in equity instrument. All equity investments are measured at fair value. and that has been established from the onset. Changes in fair value are recognized in profit or loss except for which the entity elects to measure the value change through other comprehensive income. So if you, an investor, you have invested in equity instrument, it is an asset for you. So if it's an asset for you, any change in the fair value of the asset have to be recognized in profit or loss, except where you have elect to measure the change or the value of the change through other comprehensive income. So if you are measuring it through other comprehensive income, you send the change to other comprehensive income, not to profit or loss. That is on the perspective of the holder. We look at it from the perspective of the issuer. He's not supposed to do anything. All right. Then we look at reclassification. Under what circumstance can you reclassify an instrument between fair value through profit or loss and fair value through other comprehensive income and amortized cost? For financial assets, reclassification is required between fair value through profit or loss, fair value through OCI, and amortized cost, if and only if the entity's business model, okay, which is the objective for its financial asset, changes such that its previous model assessment will no longer apply. So if there is a change in the business model objective compared to the previous one, and the previous one can no longer be applied, then you can do reclassification. So if financial asset based on the business model, you are measuring it at amortized cost, and there is a change which the previous one cannot hold, you can reclassify from amortized cost to fair value through profit or loss, or fair value through other comprehensive income. And then when this is done, it must be done prospectively from the reclassification date. So it must be done, if you have done the reclassification today, you don't go back, but you continue from this moment into the future, prospectively into the future. And reclassification is not allowed for equity investments measured at fair value through OCI. So if you're an investor, you have equity investments and you are measuring it through OCI, reclassification is not allowed for equity investment. For equity investment, reclassification measured at fair value through OCI is not allowed. So in summary, we have been exposed to the subsequent measurement of financial asset and the rules on its reclassification. In the subsequent sessions, we'll be looking at the subsequent measurement of financial liabilities as well. Thank you very much for your time, and see you in the next session.